All right, we're going to go ahead now and get started with our webinar. So welcome everyone to the SC Launch and Learn with Matt Smith and Janelle Fox with Elliot Davis. Today we are discussing the management of cash flows for startup businesses. Before we begin, I'd like to go over some housekeeping items. First of all, if you can hear me, please raise your hand in the webinar controls. All right, Shannon, thank you. Welcome. Can anybody else hear me? Great. Thank you, Kaj. Great. Y'all can go ahead and lower your hands. Secondly, on the format of today's webinar, we will keep all audio for the audience muted. So if you have any questions, please feel free to type them into the webinar controls at any time. We're going to go ahead and pause about 20 minutes in for Q&A. And then again, we'll have a Q&A period at the end. I will be reading the questions out loud, and our presenters, Janelle and Matt, will be answering them. My name is Julia Linton, and I serve as the Operations Manager for the SC Launch program here at SCRA. Please join me in welcoming our speakers as they dive into our topic. Managing cash flows, by the way, is one of the most important things to consider when starting a business, so I really want to applaud all of y'all for being here and recognizing this important topic. So hosting this webinar will be Matt and Janelle with Elliot Davis, as I mentioned. Matt Smith has more than 20 years of finance and accounting and operating experience in both public and private accounting. He assists companies in accounting and system consulting, financial reporting, and outsourced controller and CFO functions. And Janelle has more than 10 years of experience providing CFO services for both domestic and international businesses. She advises clients using a team approach. So Matt and Janelle, I'd like to welcome you, and the mic is now yours.
Great, thank you so much, Julia. And welcome everybody to our webinar. We're really excited to be able to talk more about cash flow management today. As Julia said, it's crucial, especially in the beginning stages, but throughout all companies during their operations. Cash flow management is of highest importance, and so we are excited to get started. So who we are. So we're with Elliot Davis, and Elliot Davis is a Southeast regional firm. There's about 750 to 800 of us, continuously growing, and we are a public accounting firm, but we operate a little bit differently where we're much more of a proactive and advisory-driven firm. And so we use our experience to help businesses to handle complex business issues, and we offer accounting, tax, assurance, and consulting. Specifically, Matt and I are in our group Accelerate, and the Accelerate group is more of the internal business management and consulting group. So what we do is everything from getting accurate, timely financial statements through strategic planning and cash flow management. Julia did introduce me some, and I talked a little bit about our department, but a little bit more background about me. I have been in business for myself before Elliot Davis, and where I handled advisory with approximately 400 business clients on average through there, and helped them to grow their businesses. And then I moved to South Carolina, and that brought me to Elliot Davis to be able to continue that and act as the outsourced controller, CFO for small to mid-sized businesses. And Matt, if you want to take a few minutes to just ad hoc a little to your introduction, that'd be great.
Yes, thank you, Janelle. As Julia said, I'm a director at our Accelerate practice. I've been with the firm about 3 years. And previously, I had the role of CFO at a software company for over 10 plus years in Greenville. Those private equity owned, and have been in other industries before that. But excited to be back at Elliot Davis, where my role is, as she said, mostly work with closely held businesses as an outsourced CFO and help them with any accounting or finance issues.
Great, thanks, Matt.
Great. Move along.
So Yeah, great. So if we, I just want to give you a little bit of upfront of what we're going to be covering today. We're going to be handling the cash flow management and why it's important for startups, the benefits of why you should have cash flow visibility, some tactics to increase your cash flow month over month, the metrics that we use in order to measure our cash flow, and the using a cash flow model to present to creditors and investors. And then ending it with what happens in typical cash crunch needs and why it's so important to have the visibility into when you're going to be needing cash. So why is cash flow so important? As Julia mentioned and Matt and I keep reiterating, why is it so important? Well, cash flows are very unpredictable. One thing that we see a lot of times with businesses is that they plan for the revenues, they plan for their expenses, and they make sure that they're going to be profitable and foresee that. But what they're not thinking about is the profitability and how that relates to when they're going to actually get cash in the door. Another reason it's so important is that cash flow management is one of the major reasons that startups fail. So typically we see that people go into business and they haven't planned for the cash needs and the capital needs that they're going to have, and they haven't planned for when things may go wrong or not work as smoothly as they initially thought. And so some of the best ideas to go into business and the best market need startups end up failing within 6 months just because they haven't properly planned for when they were going to need cash. And then using a cash flow model, as we'll get into, it can really help you to foresee and plan for those times of cash crunches so you can be prepared, whether that's to have an investor, to have a line of credit, whatever it may be, so that you can be prepared for that cash crunch time. So if we were to talk about some statistics of cash flow and how that affects startups and small businesses, I mean, typically 61% of businesses, just from this survey done, have struggled regularly with cash flow. And typically we see that, and this will go over to the 43% of small business owners not being at risk of not paying their employees by payday. There's a heavy correlation between those two, where a lot of times we see that the cash flow crunch then leads into not being able to pay their employees, and the employer being very stressed at payday time because that's generally one of their bigger expenses. And so 69% of small business owners have been kept up at night by that. And that's typically because they have a lot of people to be responsible for. They have customers they have to deliver to. They have vendors that need to get materials or services in the door, and they have employees that need to be paid in order to support their families. And then additionally, 82% of business failures are due to just poor cash flow management and understanding of that cash flow. And so why it's so important is this is actually something that we can prepare for. It's not something that we can't be educated on and use. And it's a great tool for all business owners to use. So I just put this little joke in here because accounting is never really exciting for most people. But I used to hear all the time this joke of how can I be out of money? I don't have any checks left. And Matt Smith reminded me, do people still know what checks are? And I feel like yes. So thanks, Matt, for making that joke with me. But there's really, there is really a funny there's a funny part to this, but there's also a serious part to this, is that a lot of times what we say is, well, if I'm profitable and I'm paying taxes on profit, I don't understand why I don't have any cash. And so that's one thing that Matt and I are really going to hone in on today is what is profit and why is that so different than what my cash position is. So to get our webinar started, I really want to start with the 3 financial statements, which I'm sure most people on the call are familiar with. And that's our income statement, our cash flow statement, and our balance sheet. And talk a little bit about how they all integrate together. So this is a classic example of an income statement showing profit, but then not showing that there's any cash. And so if you look specifically at the income statement, the bottom of the income statement, it's saying that we have pre-tax net income of $31,000. And so that means this is great. We had revenues, we kept our costs down, our margins are good, we're covering our overhead, and all that sounds great. We've been profitable, and specifically for a startup, a lot of times it takes a bit to get to that scenario. But then as you'll see when you get to the cash flow statement, the very first line in our cash flow statement starts with that pre-tax net income. It says you had $31,000. Well, once we add back our non-cash items, we put in the changes in our working capital, which we'll touch base on this a little bit more, but even though it said on your income statement that you had sales and you were profitable, it doesn't necessarily mean that you've received in all that money. If there's terms with your customers, whether it be, net 10, net 30, net 60, we might show profitability, but we may not have received that cash in yet. There also could be a net change in inventory, which did not affect our income statement. We purchased some more inventory that has not yet hit it, but did use our cash up. And then accounts payable, the change in increasing our dues to our vendors, our liabilities to our vendors. And then if we go down even further, so now that says, okay, how much cash flow do we have available just to pay our debts and our financing activities? And so one of the things we're not considering is a lot of times is we have net income, but we have a debt service because we're a startup and maybe we did obtain a loan in that initial startup phase and we have to pay on that monthly. And so that takes away from what our cash position is. When you get to the bottom of that cash flow statement, it actually says how much is available to owners. That's negative $24,000. And so one of the things we like to see is when we do the cash flow model, we want to be able to portray when we're going to have negative cash and to take into consideration when we actually receive money from our customers on terms. When do we actually pay vendors? And I'll let Matt get into that in much more detail, but this just shows right there, profit does not equal cash. And here's the reasons why. And then just to show you how that plays into the balance sheet, you take the net cash flow over, you'll see right at the top line there, that's our cash and our cash change. So from December of 19 to December of 2020, our net cash change was negative $24,000 after we've received and had sales, had profit, paid out to our vendors, received in money from our customers. Our actual cash change was a loss of $24,000. And so this is how you can see a little bit of a better picture of how these financial statements actually all work together to help you to manage cash better. So Matt, I'd love for you to lead into this and our financial statements and how they work together and show them more of a model and an example of a model so that it can help them to build that out there on their own.
Yeah, thanks, Janelle. Well, first, what is a cash flow model? I'm sure many of you know, but a cash flow model is a forecast of the income statement, balance sheet, and cash flow statement. And a good cash flow model is created usually on an accrual basis, which investors and banks prefer. I think a lot of people do a cash flow model, use just an income statement, and it doesn't really give you the whole flow of how cash can be affected by different things or different assumptions. Cash flow model can be used as a budget and can be as detailed as necessary. A lot of cash flow models we build, we end up using them as budgets also, and roll over time, keep adding years and months to it, and it can be a good tool to track to actuals. Also, cash flow model is used, it helps a business plan for the future finances and to help manage cash proactively, help identify potential problems in months when businesses may have cash shortfalls, in case you have seasonal business. Always good to show that when you may need the cash. Also, good cash flow model is used. You can run different scenarios to see how they affect cash, and we'll get into that, how an integrated cash flow model can be very useful in changing different terms for accounts payable, AR, sales, etc. And they're also very good for presentations to banks and investors. And we'll get into a little bit more of that later. So tactics to manage cash flow. So before we get into the actual model, I'd like to review some tactics to manage cash proactively, and then we'll jump into a sample model in Excel. Obviously, faster collections of receivables, right? Everybody wants to get paid fast. You can use early payment discounts. I've seen customer deposits, but it seems like most people have problems asking for money and collections. I know nobody likes to get on the phone and call and ask for people to get paid. It can be uncomfortable, but obviously it's a necessary evil we run into. Had an old boss, and his motto was, "Don't ask, don't get." So usually you don't get it until you ask for it. Then obviously slower payment of vendor payables. Negotiating out terms, using purchase cards or credit cards can help manage payables. Terms with new vendors, usually you need to gain some trust or have some history with them. So some of that can be difficult for startups and new growing companies. But once again, just negotiating with vendors and having a lot of communication usually helps. I know you could have big orders that you may, have a large order. We can get into an example later, but you have to buy a lot of inventory up front before you get paid. And usually those are things that come up with small businesses where they run into problems with cash. So negotiating deposits up front, negotiating terms with vendors, or some combination of those two, can help. And then companies with inventory, when applicable, inventory valuation and how much inventory to hold is usually pretty tricky. It takes time to get pretty good at. There could be a lot of wasted inventory or scrap inventory that's lost. Because inventory is basically cash on the floor, so you want as little as possible. And then negotiating loan terms with banks or other lenders, obviously the longer terms it's possible, lower interest rate. Those are things you can model out and see how much debt you need, and banks can usually work with you and give you some kind of terms that works with your future cash flow. And then tax planning. Have your tax accountant. There are research and job credits and R&D credits out there that are missed a lot by small businesses. And some of having these credits can be used and carried forward when you have profits to help offset, future tax payments and help you manage cash positively. So next, we're going to go into the model. And let's see if this works. So we have an example. In our example, it's a condensed cash flow model that's built out monthly for 2 years. It's XYZ company. It's just assumed to be a small company who sells some sort of product that requires inventory and has some service revenue to go along with it. I think maybe cabinets or pools or anything like that. It's I've learned to create a made-up business with financials is somewhat difficult, but for it to make sense. But conceptually, we're going to go through different scenarios here. So the cash flow model has a balance sheet, and it's monthly for 2 years, income statement with the same format, and a cash flow statement, like we talked before. The example that Janelle went over earlier was a condensed format of this, and we have ways to do that up here to hide all the columns. And then we have an assumption page usually for the balance sheet and income statement. So in this example, our income statement, we're starting in 2020 We've had some ramp up period. We've got first month sales of $40,000 for product. We've got first month sales for service revenue of $10,000, and a growth rate for each monthly for year 1 and year 2. Usually the cost of goods sold here is a percentage of revenue. We're using 50% for the products and 40% for the services. And then operating expenses is condensed, and these can be broken out as much detail as you want, but we're using some fixed expenses and then variable expenses that are usually a percentage of revenue going forward. Obviously, I have depreciation, and then an income tax rate, it's interest rate for any debt that we may have. And then the balance sheet assumptions that we'll get into is accounts receivable. We have that AR as days on hand. So in this example, we've got 30 days for every time we send an invoice before we get collected. And we've got inventory of 45 days. So we need at least 45 days of inventory for future sales. We started with equipment, $50,000, and debt on that equipment of $50,000. So we were able to get a loan on that. So we also have payables of 20 days. That any time payable stays on hand are 20 days. And also some category spots for a credit card or line of credit, which can offset, and we'll show how that works with the cash. And then in this example, we have beginning equity of money that's put in of another $50,000. So now when we go to the income statement, as we saw before, we had an annual income of $31,000 for the first year. But when we go to the balance sheet, we had a cash burn. We started with $20,000, but we down to negative $4,000. So we lost $24,000 in cash during the year, even though we had an income. And a lot of things factor to that. So when I'm doing a model, and we had all those assumptions in, where do I run out of money, and when and how do I fix that, right? So hopefully I'm not moving too fast, but one thing that affects cash are all these days outstanding. So if I can receive, and I'll go through an example of each one. If I can collect 10 days faster through getting deposits or just faster collections, my cash changes drastically, right? So instead of having negative $24,000, I only had a burn of about $1,000. So just an example, and we'll change that back. Inventory. I've got 45 days inventory. If I can lessen the amount of inventory I need on hand, obviously you're going to see the same thing, right? I have less inventory, just less money to spend out, and affects cash a little bit better. I mean, a little bit better than before, not as good as the receivable terms, but I burned $10,000. None of these things affect the income statement, but they all affect cash flow. And these are, things that are important to manage your business. And the same thing with payables. If I extend my payables by 10 days, no more negative cash, right? So these are all tactics. And I don't know if this is a good time for questions or not. Julia, if there are any.
Yeah, thank you so much. Now, or if you want to get to the end of this, let's just say that I will prompt the questions right now, and y'all can start typing them in, and then maybe you could finish the sheet and then read the questions, because as of right now, there are no questions in the queue. Okay. But if you want to, get a glass of water or, take a sip of water, we could let the questions come in, but as of right now, there are no questions.
And that's fine. I was just going to run through a few more examples on these
Okay.
assumption pages and how they roll through the model. Okay?
Okay, great. Oh, why don't you, let's see. One question did come in. Are you ready for that question now, or do you want to keep going?
I'll take the question.
Okay. There are acronyms, so I'm going to go ahead and just spell it out. The question is there an ideal ratio of AR, DOH, and INV, DOH, and AP, DOH?
I think there are KPIs for each industry has probably a best practices for those ratios. So it's hard to say by industry. I'd say typically AR is 30 days or under. AP is typically 30 days. I mean, those are how normal businesses work that aren't cash businesses, right? Like a restaurant or anything like that. So it's kind of hard to answer that. I think if you got specific in your industry, we can help with that a little bit. And I think inventory is usually the trickiest on how much inventory you need if you're an inventory business. Obviously, if you're in restaurants, it turns over quickly. In other larger businesses, it takes a lot lower. But I would say the less the better, but that doesn't slow down sales at all.
Great, thank you. So there are no other questions on the line right now. So
okay.
If you just want to keep going, then we'll open the line back up in a little bit for more questions. Thank you.
Okay. So back to the balance sheet where we had our original assumptions and we have negative cash balance. So in these models, like I said before, you have these assumption tabs and you want to be able to change the assumptions and it flows through the model so you don't have to change anything on the income statement or balance sheet. And so if we got a problem of $11,000 max and we have some payables and inventory and accounts receivable, a couple ways to help cash flow is maybe a credit card, right? And if we can get an example of a percentage of our AP, if we're paying our AP with a credit card, usually extending it another 30 days, or a purchase card, helps your cash flow, a really good deal. So if you can get 25% of your payables paid with a credit card, it really helps cash, in this example, $10,000. So we're moving some payables to a credit card and kind of consistently pay this credit card off every month and most likely buying inventory with it. So just an example of something to help cash flow. Change that back. And then a line of credit. A lot of banks will, if you have a lot of inventory or AR, will loan against, I'll have a line of credit against accounts receivable and inventory, and different amounts for each. Typically, they'll do a percentage on AR and a percentage on inventory, maybe 20 to 50%. And something like that can really, really help cash flow, especially in seasonal businesses who may have large purchases and need working capital for a certain amount of time where they need a line of credit and they will have cash later to pay it back. But building a model that can put all these assumptions in is usually our goal. And so you can do different assumptions, because there could be times when you may not have slower AR and you need a line of credit, and then you could say, well, I can't do 60 days, right? Because I'll never be able to pay any bills. So these are kind of the assumptions we can run through with you and try to figure out what the best practices should be and have strategies going forward. Obviously, the income statement assumptions, changing your cost of goods, your margins obviously affect that. And, you know, if your costs go up and you can't raise your prices, you know, it affects cash negatively. For instance, here about, you know, another $6,000 or $7,000 if your margin goes down 5%. So this is not a real company. These are all kind of conceptual ideas that a good cash flow model can help you think through some things and help you with pricing. Obviously, demand and competition runs that too, but I think if you put a lot of thought, you know, in your business and how you want to market yourself and how your pricing is and you know what you need to charge really goes a long way in presenting yourself and raising money. And so any other questions about the model? I think I went through everything I wanted to show. You know, one other thing is, we'll go back to our regular assumptions where we had a cash problem. And so what if I have just a large order? And this is what I think happens a lot. We're going at a certain rate. I got a certain amount of inventory. I've kind of figured out my cash flow, but I get a giant order. And I'll move that back. So what do I do about that? Or how does it affect my cash flow? So I'm going to need more inventory. You can see cash changes drastically because of all the inventory I had to buy. And it's usually a short-term thing with these large orders. And then I'm getting collected the next month, if I'm lucky, and it comes back. But that's where a line of credit, working with a bank, or working with your customer to get a deposit can really help. And that's when we're talking about working capital and having enough working capital. It's usually with growth companies who are growing every month. You got to spend money before you get collected, and it's always good to have some kind of line of credit or raise enough early on to help offset these growth problems. So how does the cash flow model strengthen a presentation to creditors and investors? Well, it does show credibility, that you've done your homework and have a plan. It also shows the viability of your plan. I've worked with a lot of companies who are putting a book together and raising money, and if you can show a bank or investors, you know, a detailed, comprehensive cash flow model where they can change assumptions, stress it, or do best case, worst case, middle case, and have something that you can use as a tool, it really goes a long way in showing your credibility and getting a lot of attention. It also demonstrates the need for funding and hopefully a path to pay it back. And also, so an accrual projection, which we have here, or a gap, is usually required from banks or investors. It helps them calculate different ratios like EBITDA or debt to equity or current ratios, current assets minus current liabilities, and just usually ratios they need to show to their credit committee or whoever else to get loans like this approved. And then finally, not being prepared. If you're in a cash crunch, what do you do, or what have we seen? So factoring, most businesses in this position, always at the beginning, usually tell me, I wish I raised more money than I needed or than I thought I needed. And usually they do that to keep from getting diluted early, or maybe they just couldn't. But it's the best time to raise more money than you need is up front and before you really get started. But once you get in there, factoring, as some of you may know, is something you can use to help in a cash crunch. It's basically selling your receivables to a third party of financing. And where I've seen this work is if you have a large customer who has terms out 90 days, that you can sell these receivables and they'll collect for you, but typically very high interest rates, 12 to 20%. I'd say average about 16%. And that's kind of a flow that's hard to get out of. Some other loans we see, we have cabbage loans here, which really are just these internet loans that are online that are fairly easy to get, commercial loans online. Cabbage is as an example. It's usually those interest rates are 30% plus, and it's hard to see the interest rate because of the fees they have. But once you blend it all together, and they'll take straight from your bank account weekly. Also very hard to get out of, and kind of a last resort thing. And then personal capital, using your home equity loan or personal credit cards. A lot of these things that you don't want to do that people are sometimes forced to do to make payroll. So these are just a few of the things we see that people are usually trying to get out of, that didn't do the right planning, or things went wrong, didn't raise enough money up front, but now they have these basically bad loans that are hard to get out of. So any question? That's really all I have. If there are any other questions. Janelle, any comments?
Great, thank you so much. All right, I am going to open up the line for questions, and in the meantime, we have one that has just hit webinar controls. The question is, how would this cash flow model look different for a company like mine that is using the executive recruiting industry?
So every model we do is different. So they're all customized, and they should be, because every business is different. The bones of it would still be the same. The formulas, depending on how complicated you want it to be. And a lot of times, I'd say that's more of a service industry. We'll build out a revenue tab based on, we're accounting firm, so billable hours, estimated billable hours times the people, and it can be as detailed as you want. And whatever is the most important to you is usually what's kind of blown out more in an assumption page that's more important. This particular model is a little condensed and pretty basic, but I guess I don't know if that answers the question, but it's just it would be customized more in the assumption page and then pull over to the income statement, balance sheet, cash flow.
I think that's a fair question. A question that I have is, where would you recommend companies go to from here? If they say, hey, thank you for the Excel sheet, I am crunching through it, I am, just loving getting organized, putting everything in place, where would you say, hey, you've got that cash flow model looking good, what is the next thing? What's the next it thing?
I guess it's what their needs are. A lot of times these models come about from I'm growing and I don't know where the cash is going. I need to get organized and budget out. Or I need to raise money. The bank is asking for projections and I need help putting that together. So it's really just, or people just may want it just to do a budget that really is a cash flow budget instead of just using the income statement where you really don't know the ins and outs of collections and payables or future fixed asset purchases or anything like that. So it depends on what the issue is, but there's usually a need, and it's usually a cash need or investment need, and somebody's asking for it.
Mm-hmm. Nice. So there are no other questions that are hitting the floor here. Oh, actually, we've got a question on the line. Ben, yes, the example Excel sheet, that is something I was going to mention in just a minute. I'm going to send out that Excel sheet in just a little bit after we go ahead and download this webinar. I will send you a link to view this webinar again, and then you will be able to, I will also send out that Excel sheet, the cash flow sample Excel sheet as well.
Yeah, I'll send that to you, Julia. There's
perfect.
A little different version.
Oh yeah, the updated one. Perfect. Thank you. So I am going to ask Janelle one question here. I am going to ask her to send us some parting words. Give everyone a little tickler for the next Elliott Davis webinar that y'all will be hosting on succession planning and how to properly strategize for exit, and a proper exit, a beneficial exit. So if Janelle, if you want to give a summary on that next webinar coming up.
Yeah, absolutely. So Peter Barton and Ryan Lovelace from our group, from our Business Advisory and Accelerate group, will be presenting on succession planning. That is something that they do regularly for all types of businesses and different industries. And it's essentially just preparing for your exit and what does that look like. And so, you know, they'll stem off a little from what we've talked about today, but really, like, what is your exit plan? Because at the end of the day, is it to just be a profitable business? Is it to sell in 5 years? Do you have intentions of passing this down to a family member? It's really taking all of those things into consideration and preparing yourself so you can meet your goals in whatever capacity they may be. So they have a great webcast planned, and I'm really excited to have them do that fourth part for everybody, and I think it'll be really a valuable webcast.
Thank you, Janelle. I appreciate that. So that one is on Friday, December 13th. I can send everyone the link to register for that as well on exit and succession planning. We had one final question. It was really kind of geared towards me. It was asking if these are available, these hour-long webinars are available and count towards CPEs or continuing professional education credits. And the answer is no, unfortunately. We haven't taken that step. It's definitely something that I have been asked in the past, and I would love to look into it more. So again, I apologize that is not something that I have done in the past, but I would love to plan for that in the future. So yeah, with nothing else on the table, I'd like to just thank Matt, and I'd like to thank Janelle for hosting this webinar today, and feel free to reach out to them. I will send everyone the information on how to get in touch with them. But thank you all for taking the time to be with us today. Thank you. Bye.
Thanks. Bye.
Thank you. Bye.